Welcome back to The Deep Dive. Today we're jumping straight into a triage of the investment landscape, using the Vivimoney Daily Report from the start of the year. Our goal here isn't just to read the news, but to really pull out the core insights for your decision-making right now.
And the mission for you today is absolutely crucial. We're in a very low-volume post-holiday market.
Right.
But despite that, it's experiencing this extreme thematic friction. You have two colossal, almost opposing forces at play.
Which are?
Stubborn mid to high interest rates on one hand, and these really complicated short-term liquidity events on the other. Getting these two wrong means getting the whole first quarter wrong.
Exactly. And the report nails it, calling this high-rate friction overlaid with seasonal liquidity. And that friction is causing a pretty wild split, isn't it?
It is. Funds are aggressively backing the whole AI and high-growth tech narrative.
While at the same time fleeing into precious metal.
At the exact same time. It's optimism and deep caution fighting tooth and nail.
Okay, so let's start with that persistent weight on the market. The interest rate environment. The 10-year Treasury yield. It's just not budging.
No, it's holding tight in that 4.15% to 4.18% zone. The 2-year is sitting around 3.47%.
And those numbers might not scream crisis, but 4.15% on the 10-year, that's a massive hurdle for high-growth companies, isn't it?
Oh, it acts as an anchor.
Yeah.
I mean, we all got used to basically zero interest rates, where high PE stocks could justify these massive valuations based on profits, 10 or 15 years out.
Right. The math just worked.
But when the risk-free rate is over 4%, that drastically increases the discount rate. Suddenly, those future profits are worth a lot less today. The market treats 4.15% as a serious structural valuation hurdle.
And this whole thing is made worse by the Fed sending, mixed signals. We know there's disagreement internally about when to start cutting rates, or even if.
And that's the key dynamic. The market has priced in a lot of optimism, a lot of cuts.
It expects them.
It does. So if the economic data, especially the inflation and employment reports coming up, if that data is weak, the market will pull those expectations forward. That'll give growth stocks a lift.
But if the data stays strong...
If it's robust and inflation stays sticky, as the report says, those yields will shoot right back up. And that puts immediate pressure on valuations. It makes every single data point a high-stakes trade signal.
Speaking of high stakes, let's talk about the liquidity drama right at year-end. This is where the plumbing of the financial system got really tense.
Yes, this is where we saw the market's internal stress test. We watched two main facilities run by the New York Fed for this stuff.
And on December 31st, they showed money flowing in two completely different directions.
Simultaneously. It was really stark.
So give us the breakdown.
Okay, first you have the Standing Repo Facility, the SRF. That's where the Fed lends money to dealers when they need short-term cash.
Okay.
That day, the New York Fed borrowed a record-level amount through it, around $74.6 billion.
Wow, $74.6 billion. That's a huge number, a big sign of stress.
It is. But now contrast that with the overnight reverse repo, the on-NRRP. This is where the Fed is basically borrowing money from, say, money market funds who need a safe place to park cash.
So the opposite flow of money.
Exactly. And that same day, the RRP saw a massive inflow of around $106 billion.
So one part of the system is desperate for cash, and another part is swimming in it. That is a staggering split. What's the fundamental concern there?
It suggests a significant temporary gap in funding. The big question now is this just seasonal? A predictable year-end thing where banks clean up their balance sheets for regulators?
Or is it structural?
Does this point to a deeper, more chronic issue in the funding markets? A crack in the plumbing that could get wider? That $74 billion in SRF usage is the yellow flag right now.
And all this is happening while the underlying economy is still surprisingly sturdy. Core inflation is sticky, and the labor market's resilient.
Correct. The recent non-farm payrolls, unemployment, they don't show a market that's falling apart. So you've got resilient growth, sticky inflation, and high rates. It's the perfect recipe for this dual sentiment.
Enough stability to bet on growth.
But enough tension to demand some serious hedges.
Which brings us right to the core market phenomenon, this divergence. Money is building rockets funding tech's future, and at the same time, it's stocking bunkers with gold. How does that show up in sentiment?
Well, it creates a fascinating paradox. If the market were truly panicking, the VIX, the fear index would be spiking.
But it's not.
It's not. It's pretty contained, hovering around 14 to 15. That tells you there isn't widespread immediate panic.
But wait, if fear is low, why is gold so strong?
That's the distinction. The VIX measures market panic, the fear of an immediate sharp sell-off. Gold, though, is a hedge against systematic risk.
The long-term stuff.
The long-term fear of currency debasement, geopolitics, or a structural flaw in the system, like that repo issue we just talked about. The VIX says traders aren't running for the exits. Gold says investors are worried about the foundations.
And we see a similar kind of caution in the crypto space, the fear and greed index. It's up a bit, but it's not exactly euphoric.
No, it's moved from extreme fear into the fear range, sitting between 28 and 34. It reflects that low volume reality. Cautious, anticipating a move, but not confident yet.
Let's get specific on prices. Let's start with those growth leaders that are really carrying the market, despite the high rates.
Well, first you have to acknowledge the core defense is holding up. The S&P 500 ETF VOO is strong near 628. The Nasdaq Q100 QQQM is holding that 252 to 255 band.
And that strength is almost all coming from the AI narrative, right?
Almost entirely. It's the unstoppable story around AI and semiconductors. You look at NVIDIA, trading near 180 to 189. Meta is robust near 650. Alphabet GOG is in the 315 to 320 range.
And for Meta and Google, the report says it's not just about AI.
No, and this is key. A surprisingly resilient advertising market is a foundational driver for them. It lets them shrug off the high rates better than other growth sectors can.
Okay, now let's go to the high-risk end. Digital assets. Bitcoin has been knocking on the door of a huge psychological level.
Yes, it has. BTC has been pushing right up near $90,000. Sampled between 89.9 and 90.3K.
But for you, the listener, the report is really clear on this point.
Unambiguous. This test needs confirmation. You need to see sustained volume and, more importantly, confirmed institutional ETF inflows. This is not a broad-based rally yet, it's consolidation at a high level.
And the other big names?
Ethereum and Solana are showing more short-term volatility. It suggests traders are still actively moving capital around between the majors, looking for the next move.
And then there's the farthest edge of speculation, what the report calls pre-stocks. What exactly are those?
So pre-stocks are shares of private companies, think Anthropic, XAI, OpenAI, that trade on these specialized secondary markets before an IPO.
And we track them because they're a proxy for what? Sure, hype.
Pretty much. They're the ultimate proxy for speculative animal spirits in venture capital, but they carry extreme risk. The data shows an aggressive appetite, though.
What are the numbers?
Anthropic pre-stocks were in the 315 to 320 range, XAI between 96 and 100, and OpenAI as high as 1,020 to 1,050.
Wow.
But the crucial warning here is that liquidity is minimal. These prices vary wildly between platforms. They're strictly for tiny, high-risk allocations. It's a measure of hype, not a sound investment.
Okay, let's pull back from the hype to the safety trade, which is showing equal, if not greater, strength.
Gold and silver look very impressive. Spot gold was reported near $43.31, and spot silver around $73 to $74 an ounce.
And the report had a really insightful metric comparing gold and crypto.
Yes, the Bitcoin to gold ratio. It's a simple measure. How many ounces of gold can you buy with one Bitcoin?
And what's it telling us now?
It is significantly decreased compared to mid-year. In simple terms, this means that while Bitcoin has gained value, gold has gained relatively faster or held its ground more firmly.
So the traditional safe haven is outperforming the digital one, relatively speaking.
It confirms that the systematic risk hedge trade is active and meaningful. Money is being actively allocated away from highly volatile digital assets and into the traditional safety net of gold.
It's the perfect confirmation of the market's schizophrenia, then. A belief that AI will change the world.
But a nagging fear that the system running that world might be wobbling.
So given this dual pressure environment, the high rate friction, the liquidity uncertainty, what's the actionable strategy that you should take away from this?
The whole strategy is fundamentally defensive. It's built on 4 pillars that are all about managing volatility and just positioning for an uncertain direction. Pillar 1 is defense first. Your core is your broad market ETFs, your VOO and QQQM, but for the AI leaders, NVIDIA, Google, Meta, you have to manage their high valuations.
Who do you do that?
The advice is to use phased entry. That's just dollar cost averaging, or DCA. Don't try to time it, just buy in incrementally. And crucially, equip protection.
What does equipping protection mean in a practical sense?
It means using tools like options or just holding large cash buffers, specifically buying protective puts. If you own the stock, you buy a put option, you pay a small premium, and you lock in a minimum selling price.
So you can still capture the upside, but you've defined your maximum loss.
Exactly. Pillar 2, hedging. We've already established the strengths in precious metals.
Right.
Hold gold ETFs or physical gold as that systemic risk hedge, your core bunker supply. Silver is more volatile, more tied to industrial use, so it's better for short to medium-term swing trades with very strict leverage control.
Okay. Pillar 3, crypto management. With Bitcoin consolidating at 90K, what's the guidance?
Keep your BTC and ETH positions small. Continue to phase in with DCA. And strict stop losses are absolutely mandatory here because we haven't seen the volume confirm this level yet.
And the pre-socks?
Strictly for small, purely speculative allocations. Remember, liquidity is terrible. Getting out can be just as hard as getting in.
And that brings us to the final pillar, liquidity, which connects right back to that $74 billion repo number.
Precisely. You have to maintain cash and high liquidity tools. That lets you capitalize on dips or just manage any unexpected volatility. And you have to keep monitoring the SRF and ROP data. If that stress is still there in mid-January, it signals a deeper problem.
And for bonds?
Use duration laddering.
Can you just quickly define duration laddering for us?
It's a simple way to manage interest rate risk. Instead of buying one bond that matures in, say, 10 years, you spread your investment across bonds that mature sequentially, 1, 3, 5, 10 years.
So you always have some cash coming due.
Right. As the short-term bond matures, you reinvest that cash at the long end of the ladder. It ensures you constantly have cash becoming available to reinvest at potentially higher rates. It helps manage your exposure when rates are this volatile.
So to sum up the core strategy, defense first, phased entry to reduce timing risk, and be really strict with your position sizing and your stop losses. Don't bet the farm on one side of this divergence. The key indicators we've covered, the high rate friction and that dramatic funding stress, they all point to this really tricky environment. Gold is proving its worth, while the AI complex keeps pushing forward, even under pressure.
And here's the final thought for you to carry forward. While we're focused on this immediate liquidity noise, the next major shift is going to be dictated by the first quarter's macro data schedule.
So watch the calendar.
You have to. You've got to track the upcoming releases like the ISM indices, the next non-farm payroll report, and especially the planned speeches from central bank officials. Those few data points will either validate the AI optimism by confirming a soft landing, or they'll dramatically accelerate the safety trade by redefining what we expect for rates.
That's the signal that will break the current deadlock.
That's the next big signal.